Over the course of the last 50 years, a localized software startup engineered itself into a massive global hyperscale monopoly. In 1975, Microsoft entered the market by building basic programming languages for early microcomputers. Today, the corporation operates across three highly integrated segments. It starts with productivity and business processes, which encompasses the Microsoft 365 commercial suite and LinkedIn's professional network. The second pillar is the intelligent cloud segment. This serves as the enterprise backbone, anchored entirely by the Azure computing platform. Finally, there is more personal computing. This division houses the Xbox gaming ecosystem and the operating system that secured their original dominance, Windows. To survive multiple technological cycles, Microsoft continually cannibalizes its own high-margin legacy products to force adoption of its next-generation infrastructure. As of May 2026, public markets value this architecture at over $3.1 trillion. The underlying capital structure is remarkably streamlined. The company maintains exactly zero preferred stock, operating entirely on 7.43 billion outstanding common shares. This timeline illustrates how that structure evolved since the initial public offering in March 1986, when shares debuted at $21 apiece. Through 9 stock splits ending in February 2003, one original IPO share now equals 288 current shares. These splits executed a clear strategy: maintain retail access and market liquidity for a massive, maturing corporation without resorting to excessive shareholder dilution. This dual access chart reveals a deliberate constraint. While revenue climbs sharply, headcount has been perfectly flat at approximately 228,000 employees since late 2024. This creates massive operational leverage, generating a run rate of $1.24 million per employee. They achieve this efficiency by freezing administrative headcount and aggressively indexing new hires towards specialized engineering. By early 2025, This capital allocation extends into strict compliance with the United Nations' 17 Sustainable Development Goals. Under Goal 13, Climate Action, Microsoft has established hard targets for 2030, committing to operate as a carbon-negative and water-positive enterprise. To meet these requirements, they enforce zero-waste protocols and partner with ecological societies to implement restoration projects precisely aligned with global standards. The ESG mandate also covers digital infrastructure. To protect system rights globally, their networks now ingest and analyze over 100 trillion security signals every day. At a $3 trillion scale, environmental and social governance operates as sovereign-level resource management, functioning as a true global security protocol. This waterfall chart breaks down the fiscal year 2025 income statement, establishing a $281.7 billion revenue baseline. Moving into the third quarter of 2026, the engine accelerated with 18% revenue growth. The most crucial metric is the operating margin, holding at 45.62%. Looking forward, the company reports $627 billion in commercial remaining performance obligations, enterprise cloud contracts that are signed and locked in for future years. Generating massive margins today while holding over $500 billion in contracted future revenue creates a financial fortress. This security provides the exact conditions required for aggressive, high-risk capital expenditure. That capital is currently being deployed to build out continuous, high-energy data centers capable of processing advanced foundation models. In early 2026, Microsoft restructured its partnership with OpenAI. They ended the net income sharing structure in exchange for perpetual intellectual property rights, while locking in a minimum of $6 billion in direct Azure infrastructure revenue this year. Simultaneously, they are leading the Stargate joint venture, a $500 billion initiative designed to construct 10 gigawatts of AI-optimized computing capacity by 2029. The near-term fiscal impact is steep. Capital expenditure projections for 2026 alone track between $118 billion and $179 billion. They are funding the largest infrastructure build-out in modern economic history directly from their own balance sheet, completely bypassing the debt markets. This chart tracks stock volatility from 2020 through mid-2026, settling near $449. Below, the forward price-to-earnings ratio compresses significantly from its historical average. Simultaneously, the bottom bar chart tracks a steady quarterly dividend of 91 cents per share. The company maintains an exceptionally low dividend payout ratio of just 20.65%, leaving massive cash reserves for reinvestment. Despite increasing these payouts steadily since 2003, the corporation has not yet reached the 25-year threshold required to be classified as a dividend aristocrat. This setup creates a rare financial paradox. Investors receive the consistent, predictable capital returns of a mature value stock, while the firm executes the aggressive capital expenditure of a hyper-growth tech startup. The sheer scale of this massive expenditure is required to maintain dominance in a rapidly accelerating cloud infrastructure market. This radar chart compares the major players. By Q3 2026, Azure reported 40% year-over-year cloud growth, directly outpacing Amazon Web Services, which posted 28% growth. Amazon's primary counter strategy relies on deploying their custom Trainium silicon and tightening their integration with Anthropic to drive down the raw cost of AI inference. Meanwhile, enterprise competitors like SAP are posting strong 27% cloud growth. Yet, because SAP heavily utilizes Azure to run its own cloud programs, their success directly feeds Microsoft's top line. In the end, Microsoft's ultimate competitive moat is structural. They possess the unique ability to fully subsidize the brutal hardware costs of the AI era using the untouchable high-margin cash flows of their legacy software monopolies.